how to tokenize things and make them digitally transactable. And we are talking basically about digital transformation. That has been a very common term in the last years. And what digital transformation is, or how it has been understood, differs a little bit from the year 2019's understanding of digital transformation. Why? Because originally it was about having a web shop, having databases, just having, let's call it, ordinary digital infrastructure for traditional trading. What we are talking about now, and what I'm going to talk about today, is how to make actually items digitally available in the blockchain space. So the transformation of things into a digital world is simply, as we already came to know it, kind of IOU. So a digital analogy of a real world asset is nothing but kind of a voucher which you can use to claim the real asset. An IOU. I owe you some real asset. And you can do this with practically everything. So be it bananas, be it gold, be it money, be it whatever. Some kind of commodity trade item. And there is, however, a certain shortcoming with how things are tokenized right now, because tokenizing things is a no-brainer. A lot of people, a lot of companies are doing it right now. You can just issue tokens, create them, put them on the blockchain, make them available. And that has been done in 2016, 17, 18. We have now, I'm not sure, 8,000 coins on Ethereum, and only a very small fraction of those coins is really usable and tradable and is worth something. Most of them are just speculative, and the promise has never been fulfilled. So, creating a valid token, one which really has value for a customer, needs some form of documentation. So something which tells the token holder what the token is about. Is it a financial product? What do I have? What rights do I have against the token issuer? Can I claim the real world asset? Can I redeem it in some form? How long is it valid? Is it invalidated after some time? Is it redeemable at all? And so forth. So, and what about the quality or assurance of quality of the underlying asset? Is there really some gold? Are there really bananas or not? Is there a third party which witnesses it? That's documentation. And when we started CoreLedger, documentation was one of the most important features actually, which we needed to introduce into the tokenization world. Then of course, the token itself. It's, as I said, the no-brainer, but also there, no-brainer does not mean that there is some difficulty behind it. At the moment, the quantification of digital items is always a token. 1, 2, 3, 4 tokens, just a token. And you can go beyond that by introducing a unit of measure. That's what we did. Using a unit of measure allows to have additional properties, or let's say additional business processes attached to it, like inflation, negative or positive inflation, storage costs, and so forth. Then compliance is one of the, let's say, coming most important features. Banks require compliance, or rather the regulators require compliance. Bitcoin is not compliant at all because it exists natively on the blockchain, and in order to trade it, you as a trader need to be subject to existing regulation. But you can't put any rules into the blockchain itself. It's just not possible. Programmable blockchains are different. You can actually put rules into the blockchain, you can put rules onto an asset. Imagine that we are talking about equity being tokenized. There you have a shareholder agreement. Shareholder agreement means not everybody can buy the token, which is clear. I mean, there's an agreement, right? If it was tradable freely on the market, then everybody could hold it. Our compliance feature allows to attach rules like who is allowed to hold, to trade that token. That feature also allows to cater for lost private keys by simply putting the lost private key on a blacklist and reissuing those tokens. And finally, there is the trading. And trading means you need to have liquidity on your token. I've recently heard that most of tokens basically lost their liquidity shortly after issuing. I will show you a different way how to trade things. So, what is the advantage of having a digital token, a digital analogy of a real-world asset? On the one hand, of course, it's more liquid than the physical asset. You don't have to pick it up from a warehouse and try to trade it. You can directly trade the digital value. That's clear. But then you can also attach additional information and additional properties. And those information which you can attach, they can also be tokenized. So imagine you have a stash of copper which you are going to trade. It's not about the copper itself which needs to be tokenized. It could be the information like proof of quality which can be attached by a company which does exactly that. It's end-to-end encrypted so that only people who have a token for obtaining the information can really read it.
5 minutes.
You can have information like tax forms or information about financing structure or whatever. So things which can be attached to a digital asset. When it comes to trading, and this is actually what I want to focus on in my talk, trading, having tokens in abundance is a blessing and a curse at the same time. Because tokens for the same asset in the form of, for example, US dollar, they are different when they have different issuers. When I have US dollars stored on a bank account by party A, which is in this case the green party, and another stash of US dollars stored on a bank account by the red party, then these two assets which are issued on a blockchain, they are different. They have a different underlying, even though they are basically issued for the dollar. Why are they different? Because if I happen to have the red dollar and I go to the issuer of the green dollar and say, hey, I want to redeem it, he will say, well, then go to the other guy because I don't want to reduce my underlying, my backing for a token which I don't know whether it has a value or not. So they are different. And when I want to use such a token in trading, there's a difficulty because imagine somebody is selling bananas and he sells bananas for the green token and only the green token. He says, I take dollars. Yes, the green dollar token. If I am the red dollar token holder, then I have a problem because it is dollar, but I can't pay with that dollar, right? The seller only takes the green dollar. How to overcome the problem? Well, we are at the trading show, so the first thing which comes to mind is, well, I have to obtain first the green dollar by trading it, using the red dollar to obtain the green one, and then in a second step, pardon? You can do it, yes, of course. Later. So, what you would do is you obtain the green dollar because that's your currency, and afterwards you use the green dollar token in order to trade it for bananas. So what happens if that takes a little bit longer than making sure that you actually get the bananas? In other words, if you finally have the green dollar tokens and go to the banana seller, he might say, oh, sorry, I already sold my bananas. And what do? You are stuck with the green dollars. That's bad. So, of course, it's possible. It's always possible. Doing it in a pragmatic way. I show you a different way. So, assume that both those trades exist on a blockchain, on the very same blockchain. Blockchain trades have a nature which we call atomic. Atomic means if you spend your red dollar token, you can be absolutely sure, because it's backed by technology, you can be absolutely sure that you will get the green dollar token in exchange. That's atomic. So there is no way that you spend your red token and not get the green token. That's atomic. And if this trade is atomic and the other one, trading the green dollar for the bananas, is atomic too, then you can combine both. And both, as a combination, are atomic. So you spend the red dollar and get the banana token. And if that happens, then you have a trade sequence. And that is exactly what I want to show you how to use it. Because trade sequences don't have to stick with just 2 assets or 3 or 4. Such trade sequences can be large, 10, 20, 100 even. And what is the result? The result is you don't even need the currency in between. This circle, which is shown here, can, for example, be entered at the level of bananas and then trading bananas into gold directly. The intermediary in that sense is not an intermediary in the classic sense. It's just another party which trades, well, bananas for, what do I have here? Green dollar tokens, right? So that's how it works. That's trade sequences. And if you apply trade sequences on, for example, the current existing banking system, then you can build something totally cool. First of all, having fiat tokens, fiat money tokens on a blockchain is always a big hassle. So nobody really wants to issue them. I mean, wanting to issue is one thing, but getting the regulator to approve that is a second thing. So approving our business model took the regulator 18 months. And there are examples for, well, business models which either have never been approved or are pending since more than 2 years. So the point here is issuing a stablecoin is simply difficult, and most likely people don't even want that. They just want trade to happen. And how to make trade happen and how to make liquidity flow from one account to another account, well, that's what I'm going to show you. Imagine you have a bank. I have a blue bank here. I use a color so that I avoid having any company names in here. So we have the blue bank, and the blue bank now issues tokens for each individual token, for each individual account holder. So account A gets its own, let's call it kind of token. So it's a separate asset. It's British pound A. And then account holder B gets British pound B. They're different. As different as the green US dollar is from the red US dollar. They're just different. And then there is the central British pound, the blue one of the blue bank. That just acts as a catalyst in between those two. Now, I mentioned something which we refer to as a compliance feature. That is simply kind of a controller which governs who can have an asset and who can have not, who cannot. So, British pound A has such a controller saying only account holder A and the bank may have it. So even if you have it, and you will have it on your phone basically, you can't trade it with somebody else. You can't transfer it directly. It's just not possible. Because this controller says nobody else can have it except for you and the bank. The bank's British pound is simply limited to the bank itself. And then the one for account holder B, you might imagine, is limited to account holder B and the bank. So if A and B do a trade with each other, then it looks like this. What happens? Some asset in the form of a token, be it bananas, be it some commodity, exchanges hands, and at the same time the amount of GBP A is reduced from, GBP B is reduced on the account. It is sent to the bank may have it. The bank sends GBP A to the account holder A, and that closes the circle. So from the outside viewer's perspective, the account holder A's bank account statement is increased by the amount of money in his own currency, whereas the account holder B's account statement is decreased by the corresponding amount in his own currency. So there is no compliance breach whatsoever. Apply this to a greater level. Transactions between banks. And that, those who are familiar with how correspondence banking basically works, is correspondence banking 2.0. So sending money from one account holder's bank to the other account holder's bank, and even on a different location. Expanding this into a network, well, means that you have a network where people hold their assets on their phone or whatever kind of device they are using, directly because it's a peer-to-peer system. It's 24/7 accessible, does not have any borders, and it works still in a compliant fashion because the banks who issued the corresponding bank holders individual currencies, so to speak, they still have a degree of control by ways of this compliance feature, the controller. So what we built, what CoreLedger built, is an infrastructure to make such things happen, like correspondence banking in that sense, or directly bartering between one commodity into another commodity, or conversion from one currency into another currency without intermediaries. It is still possible as an intermediary to act in such a system, to offer those trades, but intermediaries are not blocking anymore. They are not. They can't act as a single point of access for certain processes to happen. And together with the other features like documentation, knowing exactly what I'm going to get, knowing what right I have as a token holder of, for example, the banana token, and having such a compliance feature in place, being able to impose negative or positive interest rates or catering for storage costs, that is the added value.